We also have to keep in mind that U.S. fundamentals remain relatively strong. GDP momentum is still around 3%. It's going to decelerate towards 2%, but overall the fundamentals are very solid for the time being.
Yeah, different story for Germany, which if you look over the past 2 quarters, this is going back to the middle of last year, they've had a contraction in the fall. They had a 0% reading for the last 3 months of the year, and we're now seeing that this could be maybe a prolonged period of weakness. How unusual would it be for a German recession to cause a U.S. one? Or how serious would it be even if it just causes a little bit of a U.S. slowdown?
Well, I think what we've been seeing over the past year is essentially the U.S. has been the sole engine that's preventing a sharper slowdown in global momentum. And what we're seeing in Europe and in Germany is that we're still not yet close to that bottom in terms of growth. There might be some green shoots, but we're still in that slow momentum type of environment. And the U.S., meanwhile, is slowing. So that buffer in terms of global growth is diminishing over time and will diminish over the course of the year.
And Paul, going back to what Bill Miller said about sort of what's playing out right now, he said the real risk would be if the Fed tightened with the curve inverted, which is clearly not going to happen. So are a couple things that might be different this time. One, which we just spoke about, is whether, you know, if it's not if the U.S. gets pulled into a slowdown, that would be unusual, and versus us causing the last one. The other is that the last time the Fed continued to hike, and this time they're already saying we're not doing anything more this year.
Yeah, I mean, I think to Greg's opening point, you shouldn't dismiss the fact that the yield curve inverted, but I mean, the lead time of an inverted yield curve to a recession, if it does happen, is usually well over a year. But secondly, the Fed has already recognized the fact that things are slowing, and they're not doing anything for the rest of the year. At least they're not hiking rates. Towards the end of the year, markets are pricing in chance of a cut, but that's another story. So I think at this point, the market sell-off today, I think when the curve did invert earlier this morning, that's when you saw the losses in the markets start to accelerate in the futures and then going forward. And I think that's a lot of it's probably just algorithms and computer-driven, because the history does show that the markets have tended to perform well, at least in the short term, following that initial inversion.
And Paul, how much more sort of runway, so to speak, is there? You know, are we talking about the kind of situation now where we have just months to go, or maybe a year? Or are we talking about the kind of situation where we could have 2, 3, 4 years of this just still play out?
Yeah, I mean, as far as when a recession is going to start, that's way above my pay grade. You know, I think what we do is we continually listen to what's going on in the markets, and we have seen some slowing data, but we've seen stabilization. And today, just look at existing home sales. You saw the best month-over-month reading in years, and the second best of the cycle. So I think we're starting to see a pickup in housing data as mortgage rates have come down. Home builders got killed last year from the whammy of tighter Fed, slowing economy, and the tax policy, which really hurt housing. So those headwinds are starting to ease with lower mortgage rates, and we started to see it in the earnings reports of the fourth quarter for the home builders, starting to see a pickup in the first quarter.
Yeah.
So I think that's something to keep in mind. And the one stock that we like is Pulte Homes to play that trend, because we're starting to see data show an improvement on the housing side. So I think these stocks can rebound in 2019 after a disastrous 2018.